Welcome. Today we're getting straight into the source material to analyze a company that has, well, really captured the market's attention. Corning Incorporated, ticker GLW. If you've been following this one, you already know the stock has been on a pretty incredible run. It's up over 84% in the last 52 weeks. And that rise is all fueled by this belief that the century-old materials giant is fundamentally changing its business model. So we've gone through everything. The Q3 2025 financials, the earnings call transcripts, all the analyst commentary. Our goal today is pretty straightforward: to build a targeted report for you right here, focusing on three key areas. First, the investment thesis. Second, the potential risks. And third, the very complex valuation picture. Okay, let's start unpacking this.
I think it's so important to set the stage here because everyone knows Corning for its history, right? Gorilla Glass, the first light bulb.
The legacy stuff.
Exactly. But the whole story has changed. The sources all show they're executing this strategic pivot that ties their future not just to, small improvements, but directly to two massive secular trends.
Okay, what are they?
Generative AI infrastructure build-out and the big push for a U.S.-based solar manufacturing supply chain. So the market is pricing in this accelerated future, and we need to figure out if the fundamentals actually justify that premium.
Let's start right there then with the investment thesis, the acceleration of their profitability. What were the key numbers in Q3 2025 that got the market so excited?
Well, the top-line growth was strong, but not necessarily exceptional on its own. Core sales hit $4.27 billion.
Which is a solid 14% jump year over year.
It's very solid. But if you look a little lower on the income statement, that's where the real proof is. Their core EPS, earnings per share, it grew much, much faster. It climbed 24% to 67 cents.
And that GAAP profitability growing almost twice as fast as sales, that's what everyone is focused on, right? This isn't just a good quarter.
No, it's not cyclical. It points to a structural improvement in their efficiency.
A structural shift.
Precisely. And that efficiency is the whole promise of their Springboard strategic plan, which they launched back in late 2023. The sources confirm that since that plan started, sales are up 31%, but core EPS has just blown past that, climbing 72%.
Wow.
It's a really clear sign that their operational changes are flowing right to the bottom line and at a faster and faster pace.
And because of that aggressive execution, they've actually pulled their timeline forward.
They have. The most important metric here is the margin expansion. Management originally said they were targeting a 20% core operating margin by the end of 2026.
A common target.
A common, but ambitious target. They're now saying they expect to hit it a full year ahead of schedule in Q4 of 2025.
So, right now.
Basically, yes. This represents a 370 basis point improvement since the plan started. For a huge industrial company, gaining almost 4 percentage points of margin in under 2 years is...
Wow.
It's a very powerful proof point.
Okay, let's drill down into the biggest piece of that, the optical communications segment. This is the AI engine everyone's talking about.
Absolutely. Optical communications, so fiber connectivity solutions. It's projected to be their single largest revenue driver for the full 2025 fiscal year.
And what's the number on that?
We're talking $6.1 billion. That's about 37% of their total revenues. And within that, the really key insight is from enterprise sales, so the products built for AI data centers. That specific category grew a remarkable 58% year over year in Q3.
So why do AI data centers need so much more fiber than, the traditional cloud infrastructure we're all used to?
The difference is exponential. It's not incremental. When you're building these huge clusters of GPUs to train large language models, the demand for internal bandwidth just skyrockets. The data shows that these GPU racks need anywhere from 16 to 36 times the amount of fiber compared to a traditional server rack.
16 to 36 times.
It's just a staggering amount of data moving between the GPUs, and it forces a complete re-engineering of the cabling.
And Corning's edge here seems to be solving a very practical and very expensive problem for their customers, the big cloud providers, the hyperscalers.
Exactly. The hyperscalers need more bandwidth, but they're hitting physical limits in their buildings, specifically the size of their conduits. What Corning did was develop these high-density fiber systems that let customers fit 2 to 4 times the amount of fiber into the conduits they already have.
So they don't have to rip out the walls.
They don't have to do major construction. It's like doubling the lanes on a highway without having to build any new road. It saves them a huge amount of time and money.
Now, connecting this to the bigger picture, this is what they call scale-out, right? Just connecting more racks. But the sources talk about scale-up technologies. Tell us about co-packaged optics, CPO.
Right. CPO is a totally different paradigm. Today, you have these separate modules called optical transceivers. Co-packaged optics is about integrating the glass fiber directly onto the silicon chip itself,
On the chip.
right on the substrate. And this dramatically lowers power consumption and latency, which are the two biggest bottlenecks for the next generation of AI. They're also developing advanced data center interconnect, or DCI, systems.
And management has put a number on this opportunity.
They have, and it's a big one. They're projecting that CPO and DCI could become a $1 billion annual business for them by the end of the decade. And that projection is a major pillar supporting the stock's current valuation.
Okay, let's move past the AI numbers for a moment. The Springboard plan isn't just a one-trick pony. It relies on diversification, especially into solar.
Yes, this is the other major leg of the stool. Corning is leveraging its deep expertise in materials science. They already make high-purity materials for semiconductors and applying it to the U.S. domestic solar supply chain.
They've got a new facility in Michigan. What kind of scale are they aiming for here?
The targets are very clear. They plan to build this solar business into a $2.5 billion revenue stream by 2028.
That's ambitious.
It is. But here's the key insight for anyone tracking the company. Management has stated that more than 80% of their new solar wafer capacity is already pre-committed.
So it's already sold.
It's sold under long-term contracts for the next 5 years. That gives them incredible forward visibility, and it really de-risks a huge part of their future growth plan.
We should also touch on the segments that provide the foundation. The display technologies business think TV glass, it saw sales down about 7% in Q3, but it's still a critical cash generator.
Oh, absolutely. Display is their cash engine. Even with soft demand, they're targeting between $900 million and $950 million in net income for the full year, keeping margins at 25% or more.
How do they manage that stability?
Through really diligent financial management, strategic pricing, and sophisticated hedging against currency and energy costs. It helps offset margin pressures elsewhere.
That brings us to the financial structure behind all this. This kind of aggressive growth requires massive spending. Is it putting a strain on their short-term finances?
Looking at the balance sheet, the liquidity picture is, well, it's mixed, which you often see in a company that's in hyper-growth mode. Their current ratio is solid, 1.56. That's healthy.
But the quick ratio is a bit tighter. That one excludes inventory, and it comes in at 0.93. A number under 1 means they're pretty reliant on selling inventory to meet short-term obligations. Is that a red flag?
I wouldn't call it a red flag, but it's certainly a key risk to monitor. It reflects their strategy. They're putting every dollar to work. Operating cash flow is strong, over $2.2 billion. But to fuel this AI and solar story, they are plowing that cash right back into physical assets. Full-year capital expenditures, or CapEx, is expected to be around $1.3 billion this year.
A $1.3 billion investment.
That's the trade-off. They're sacrificing some immediate liquidity for what they hope will be long-term dominance in these new markets.
Which brings us directly to the risks and the valuation puzzle. With a $1.3 billion spend, the biggest operational risk isn't that demand slows down, it's that they can't keep up. It's supply constraint.
That is the #1 operational risk right now. Demand for their high-end AI optical products is so intense that management admitted on the call their supply chain is quite tight. In fact, in Q3, the dollar increase in their enterprise revenue was actually lower than the year before.
And that wasn't because of slowing demand.
Not at all. It was purely because of limitations on how much more product they could physically get out the door. They can sell more fiber than they can make right now.
And if they can't scale production fast enough, they risk losing those big hyperscaler customers to competitors like CommScope or Amphenol.
Exactly. And that pressure is why they're being, let's say, measured about expanding. They're negotiating with these huge customers to help share the risk of the capital investments before they go all in on building new capacity.
So it's a prudent approach, but it could be too slow.
It's a strategic choice. They're picking risk mitigation over maximum speed, and that choice is probably the biggest near-term execution risk they face.
Then you have the external financial headwinds. What are the costs associated with these big production ramps?
They do come with a short-term price tag. The new AI and solar facilities had some temporary higher costs that hit Q3 EPS by about 2 to 3 cents. You've also got tariffs, which were another 1 to 2 cents, plus broader inflation.
And we can't forget the weakness in some of their other businesses.
Right. The automotive segment is still seeing some weakness, particularly in heavy-duty markets. So it's not all smooth sailing.
There's also market sentiment to consider. As the stock ran up toward its 52-week high, there is some notable insider selling.
There was. Over $15.4 million in insider sales were recorded in the last 90 days. Now, executives sell shares for all sorts of reasons, but seeing that volume near the recent high suggests that, for some insiders at least, the current price might be a near-term ceiling.
Given all that, let's tackle the valuation puzzle. The stock is clearly priced for perfection.
It absolutely is. Trading around $85 after nearly doubling from its lows, the valuation metrics based on past performance are incredibly stretched. The trailing PE is, depending on how you calculate it, anywhere from 50 to over 80.
Which just means the market is looking entirely to the future.
Completely. But the forward-looking metrics, the ones that bake the springboard acceleration, they tell a more nuanced story.
Okay, what do they show?
The forward PE drops significantly, down to about 27. And that's based on the consensus 2025 EPS estimate of $2.55, which is what the market is betting on them hitting.
And what about analyst targets?
The median price target is around $98, which implies about an 11% upside from here. But the division among analysts is striking. The targets range from a low of $60 all the way to a high of $110.
That's a huge range. It shows real disagreement on whether this will all pay off.
It's very informative polarization. For context, we saw one discounted cash flow analysis that, using more conservative inputs, put the fair value at around $66.
So from that perspective, it could be seen as 33% overvalued right now.
Exactly. It just demonstrates that the high multiple is only justified if that sustained structural EPS growth happens exactly as planned, or maybe even faster.
So what's the bottom line for someone tracking GLW? We've got explosive growth drivers, massive capital requirements, and a really polarizing valuation. It's a classic high-stakes growth story.
It is. And to their credit, management has proven they can execute by getting ahead of schedule on their Springboard plan. That's impressive. But the challenge is still that massive. It required $1.3 billion in CapEx for 2025. That investment has to deliver. And if we connect this to the bigger picture, the company has earned its premium valuation. So the ultimate test now, in the near term, is this. What will the market punish more?
Okay.
Will it be a supply-driven failure, meaning they just can't make enough fiber fast enough to meet demand? Or will it be for simply failing to hit that newly accelerated 20% operating margin target in Q4? Which risk do you think is more likely to move the stock, given how high expectations are?
That is the essential question. Thank you for joining us for this strategic analysis of Corning Incorporated. We hope this is giving you the foundational knowledge to better understand this complex and high-stakes materials science play.